We are going to look at a question on business combination. In any business combination question, it's very important that at the beginning you identify whether it is an acquisition of shares or it is an acquisition of assets and liabilities, because this is going to affect the formats of the journals that we prepare later. So if you take a look at part A, it says that Red Limited acquired 80% of the ordinary shares. So right there, you can see that in this question, we want to prepare journals for acquisition of shares. For acquisition of shares, there's no need to calculate goodwill or bargain purchase gain, because goodwill will be recognized as part of the consolidation. So all we need to recognize is the amounts that we want to invest in that particular entity. So in this question, it says that Red Limited acquired 80% of the shares, and they are able to offer $1 cash plus 1 share of their own. So it's 1-for-1 acquisition for this one. So if it says that it's 80% of the ordinary shares, we need to find out exactly how many number of shares that you're going to acquire. So in this question, you can see that we have a lot of information provided here. But most of them are irrelevant because there's no need to recognize individual assets and liabilities. All you need to know is to find out the number of shares that you want to acquire from Chem Limited. For this one, the information is near the bottom of the balance sheet. So in here it says that in total there are 50,000 ordinary shares in Chem Limited, and you want to acquire 80% of that. Okay, 80%. And the price that you want to pay is $1 cash plus 1 of your own shares. And here it says that shares of Red and Chem were trading at $2.86 and $2.50 respectively. And remember, you want to offer your own shares for their shares. So the information that you want is your own share price, $2.86. And then at the end, you also are given information about the cost of acquisition as well as the legal costs, which we'll deal with that separately. Okay, now we know all the information. Let's put them together and then prepare acquisition analysis. So with acquisition analysis, because there's no need to calculate goodwill or bargain purchase gain, as a result, all you need is to calculate the cost of acquisition. So with the cost of acquisition, first of all, you need to know how many number of shares that you want to buy. So in this one, the number of shares equals to 80% of 50,000, because this is the amount of shares on their financial statement. So in other words, we want to acquire 40,000 shares in total. Okay, then after that, we need to offer the purchase consideration. So the purchase consideration, we have the cash component. So the cash component is $1, and you want to buy 40,000 shares in total, which give you 40,000. After that, you also got the shares components as well. So the shares component, you are offering them 1 of your own shares to 1 of their shares. So right here, you got 40,000 that you want to buy in total, and the share price of your own at the acquisition date is $2.86. As a result, the shares component is $114,400. So in total, once you add these two up together, so the total equals to $154,400. This is the cost of the acquisition, and this is what we want to recognize in our journal. So in your journal entry, our main journal entry is about the cost of acquisition. And remember, we want to recognize the investment in that particular entity, and there's no goodwill or bargain purchase gain. So when you acquire investment, from your perspective, this is an asset. And what you are buying is the share capital of another company. So on the debit side, we want to recognize shares in Chem Limited. Based on our calculation, the total amount that you are offering to them is $154,400. Okay, so that's an asset you want to recognize. And then on the credit side, that will be about your purchase consideration. Again, based on our acquisition analysis, it says that you want to offer them $40,000 cash and then $114,400 of share capital of your own. It's very important that you understand the shares on the debit side is an asset, and then on the credit side is the capital that you want to issue to them. So it's completely separate. So on the credit side, we want to credit cash. Based on our calculation, is $40,000. And then you also want to offer them share capital. And this share capital is your own share capital. So in our calculation is 114,400. So that will be the journal for the acquisition. And then if you go back to the first page, you can see that we also got $5,000 of cost of issuing shares and $6,000 of legal costs. And according to WSB 3, we need to distinguish these two different kind of costs. With the cost that is directly related to the share issue only, we want to offset the capital directly. On the other hand, any cost that is in relation to the acquisition, in this case we got a legal cost, we want to recognize that as a separate expense. So for this one, first of all, we got $5,000 of share issue costs, and we want to offset directly against capital. And then we credit cash. So that's the cost in relation to share issues. After that, we also got $6,000 that's legal fees expense, and according to the question, is in relation to the acquisition. So we want to recognize expense directly. So it says that it is a legal fee expense, so we just write down legal fees expense. And then we also want to credit cash as well. Okay, so that will be part A. Part B is also another example of business combination. With this particular question, once again, right at the beginning, you need to identify whether it is an acquisition of shares or whether it is an acquisition of assets and liabilities. So in this question, you can see that on 1st of July 2017, Dory Limited acquired all of the assets and liabilities. Okay, this is the keyword. Assets and liabilities. So this is an acquisition of business. This is an acquisition of assets and liabilities. So in our journals later on, as you recall, we are going to recognize every single individual assets and liabilities. And also, in your acquisition analysis, you need to calculate goodwill or bargain purchase gain. So we can read the rest of the question. It says that Dory Limited agreed to pay Hank $60,000 cash and also 180,000 fully paid shares, and the price of that shares is $2.50. So we got the cash component and also the shares component as well. And after that, we also got the share issue costs and legal costs as well, which we'll deal with that separately. Okay, after that, we got the assets liabilities of Hank Limited. Remember, according to WSB 3, the acquisition analysis, the starting point is the net fair value of identifiable assets and liabilities. The keyword there is fair value. In this table of information, we are given both the carry amount and the fair value. We are only interested in the fair value, not the carry amount. And that's all the information that you need when it comes to the acquisition analysis. So we want to add up all the assets and then minus all the liabilities, and then the difference, we compare that with the purchase consideration. As a result, we are able to work out whether for this particular business combination, do we have goodwill or do we have bargain purchase gain. So let's put all the information together. So let's put the acquisition analysis together. So as I said, the key is to write down every single assets and liabilities together, and then we want to take the difference and find the net fair value. So let's start with the net fair value. So for this one, if we go back to the question, you can see that we got 10,000 cash, and then we got 15,000 account receivable. what I normally like to do, because your acquisition analysis is going to help you to prepare the journals later. So to save you some time and refer back to the question, when I write down the acquisition analysis, I tend to write down the name of the account as well. So after that, you can just refer back to your own acquisition analysis. So we got 10,000 cash, 15,000 account receivable, and then after that, we also got 70,000 inventory. And then we got 290,000 equipment. And then we also got trademarks of 200,000. That's all the assets that we have on that financial statement. And remember, we are interested in the net fair value of identifiable assets and liabilities. So after that, we also want to minus the liabilities. According to the information, we got 20,000 account payable and also 75,000 of bank loan. So both of them you need to take away from your calculation. So after that, you have all the assets minus all the liabilities. So the amount of net assets equals to 490,000. 490,000. After that, you want to compare with the cost of acquisition, which is consideration transfer. So the purchase consideration. So the purchase consideration, according to the question, we got the cash component and also the shares component as well. So the cash components, we got 60,000 cash that we offer to them. At the same time, we also got the shares components. The question says that we want to offer 180,000 and the share price is $2.50 each. 180,000 multiplied by $2.50. So when you do this calculation, you'll find out that the amount is 510,000. Okay, now you need to compare the amount that you pay compared to the value that you get in return. So right now you are paying 510,000 and the net fair value that you acquire was 490,000. Because you pay higher than the fair value, as a result the difference would be goodwill. So for this one, we got 20,000 of goodwill. And all this information, you are going to use that in your journal. So every single asset and liabilities, you're going to recognize that asset on the debit side and then liabilities on the credit side. You'll also recognize the purchase consideration as well. And finally, you also recognize goodwill as an asset. Okay, so let's put all the journals together. So the main journal is a very long one because when you acquire assets and liabilities, you need to recognize every single individual assets and liabilities together. So in this one, we want to debit cash. Pretty much I just copy directly from the acquisition analysis. Cash 10,000. Account receivable, we got 15,000. Then we got inventory of 70,000. Equipment of 290,000. Then we also got trademark of 200,000. Okay, so that's all the assets that you find in there. On top of that, the other asset that we want to recognize is goodwill, and based on our calculation, we got 20,000 of goodwill. So that's all on the debit side, that's all the asset. On the credit side, there are two things we want to recognize. First of all, that's the liabilities from the acquisition, and also you offer them purchase consideration as well. So first of all, account payable, that's 20,000. After that, we also got bank loan, 75,000. With the purchase consideration, the cash component of the acquisition was 60,000. And then the share components of that is 450,000. So that's all. And in the long journal, a good practice is to add up all the debit and then add up the credit to make sure that it is actually balanced. So if you find out that it is not balanced, you need to cross-check back with your acquisition analysis to see whether you are missing anything. So in this particular case, it is balanced, so that's all right. So this is the main journal, which will recognize individual assets and liabilities. After that, just like Part A, we also need to recognize the share issue cost as well as the acquisition cost. So based on this question, it says that the share issue cost was $2,500. So once again, we are going to recognize directly against capital. We debit share capital, 2,500, and then credit cash, 2,500. After that, we also want to recognize the acquisition cost as well. Once again, this is a legal fee expense. In this case, that's 1,800, and then we credit cash of 1,800 as well. Okay, so that is it for this question. So as I said right at the beginning, the key for business combination is to recognize right at the beginning whether it is an acquisition of shares or acquisition of assets and liabilities.